SJ Balesh, who's Senior Director at Treasury IDFC, joins us from Mr. Balesh, thanks very much for speaking with us. What do you make of the currency fall? And we are given to understand that there are a lot of bearish bets, not just from domestic institutions, but also from foreign institutions, which are putting pressure on the currency on the downside. What kind of targets are these bearish positions holding at this point?
The fundamental view on rupee is essentially down because of the huge deficit and also we aren't really seeing too many inflows happening on the capital account, and therefore that's getting reflected in the way rupee is moving. But it's very important, as others have been saying, that we need to cut the volatility, because if it continues, it's not going to help anybody, and it's definitely going to hurt everybody. Having said that, I think a lot of these fixed income investors, especially from the overseas markets, have taken positions, in the first quarter of the current financial year, when dollar rupee went down from 50s to 48 levels, and who thought, who would definitely trying to cover themselves, because they could already be out of the money in most of their exposures, and therefore and there are strong structural measures taken by government. I think it's going to hurt more inflows coming into the country.
So what kind of targets are we working with on the currency right now?
See, currently, we have taken some exposures are being, already we have breached most of the targets, and currently, the way we would look at it, unless we see Reserve Bank coming in strongly, we would definitely see 55. We are touching 55 very soon.
Aside of the daily firefighting that the Reserve Bank is anyways doing, and not that it's really helping too much because we are now at 54.43, is there a structural change or some couple of structural steps that can be taken to ensure that at least the volatility gets curbed? Never mind what happens to the natural trajectory of the rupee.
Sure, I think a few structural measures which has been spoken about, including moving the oil payments out of the markets, and then RBI taking care of it separately through a window, would definitely help curb some amount of volatility in the system, because that's oil payments is one of the big payouts from the country.
Okay. Aside of that, I know you mentioned that you do believe that there is probably a matter of time before the rupee does go back to 55. We had a guest earlier on, before you came in, who did mention that even if there is a bounce back in the rupee and it does appreciate, they do not believe that it is possible for the rupee anytime near to go above the 50 mark. Assuming that does happen and the rupee does appreciate, you believe the macros are suited for the rupee to stay below the 51, 51.5, 52 kind of a mark? Or do you believe the appreciation as well could be as swift?
See, for rupee to go below the 51 mark, I think there are a lot of structural changes that needs to be done, and India needs to once again become investment destination for foreign investors, both in equity and debt. If we see that change happening, and we see see that happening, why not? We could go back the pace at which we came up from 51 to 55. We could also see it going back, but for that the fundamental change needs to happen, where India once again becomes a popular destination for investments, both from equity and debt perspective.
How are you managing or approaching your treasury portfolio right now in terms of a broad call that you're taking, especially with the G-Secs, given where the yield is and the expectation or the impact that all of this will have on the RBI's outlook on rates?
See, that's one market which is still looks supported because of the secondary market purchase and OMOs being done by Reserve Bank of India. We have seen 10-year ranging very broadly between 48-50 last couple of days after the Monday announcement of OMO. That rates would remain at these levels. The G-Sec 10-year yields would remain at these levels as long as there is comfort in the market that RBI would support the yields both through OMO and then liquidity inducing measures. If any week that you will see RBI not coming out of the OMO, you will see once again 10-year G-Sec yield moving up, not very sharply, but at least 5-10 basis points. So very broad range for 10-year yield would be 845 to around 860 level.